So how does an ETF work? What is an ETF? But also, who should buy ETFs? These are very important questions, especially when deciding whether or not to invest in ETFs. And in this video, we're going to answer them. Hey, it's Dario and this is Divity Trading, a platform where we can share our best tips and tools when it comes to trading, investing or finance in general. And if you love the subject, please consider subscribing. ETFs are probably one of the safest investments we can have. Along with index funds, they give a pretty low risk opportunity for anyone who's willing to educate themselves a little bit to make their capital grow in the long run. But to do that, and so to invest in ETFs, we first need to understand what ETFs are and how they work. But hey, if you enjoyed the video, please leave it a like and let me know in the comments down below if you are thinking about investing in ETFs. So basically you can think about an ETF as being a giant pool or basket containing various assets such as commodities, stocks, currencies and so on. But who creates ETFs? Who decides which assets to buy? Well, ETFs are created by specific companies that choose to do it. These companies can be banks or companies that are just built in order to create ETFs. So for example, we have the Deutsche Bank, the Vanguard Group, the BlackRock, and so on. After being created, the ETF has to be approved by the relevant authority. These companies also decide which assets to buy. But how do they decide what to buy? There is a specific criterion by which ETF companies decide what to buy. But to understand this, we first need to understand what's the purpose of an ETF. So the goal of an ETF is to replicate a specific index, but don't just think about the S&P 500. They can replicate any type of index. So we have commodity index, currency index, real estate index, and so on. Now, if the goal is to replicate an index, the assets are bought with the intention to have the same performances as the index of reference. So the assets that an ETF company buys can be the exact same ones of the index of reference with the same weights, or they can differ a little bit, especially on the weights. But the main goal is always the same: to follow the index of reference. Now, to complicate things a little bit, we should mention that not all ETFs actually buy the underlying asset of the index they want to replicate. So ETFs can be divided in two categories. The first one being the one that we talked about earlier. So the company that creates the ETF actually buys the underlying assets. And these are called physical ETFs. The other type are swap-based ETFs. These are ETFs that don't physically own the asset, but they ask a counterparty that owns the asset to give them the returns of the index in case of an appreciation, and in the case of a depreciation, the ETF will pay the loss to the counterparty. This is made so that the ETF can buy the index but not actually pay the commissions to buy the single assets. Of course, this is not for free. The counterparty will charge an interest, and this interest is based on the interest that banks give to people that ask for a short-term loan, the so-called LIBOR. It's also good to mention that these type of ETFs are actually a little bit riskier. This is just because if the counterparty goes kaput, the ETF company is left with nothing in their hands, and so are you. But again, the main concept to understand here is that an ETF's job is to replicate as efficiently as possible an index of reference. So who should buy ETFs? Well, since ETFs are instruments that are created in order to follow a specific index, so a collection of assets, they are very good at lowering the risk and the volatility of the single assets. In other words, if there is an asset such as a stock that lost a good portion of its value, there is probably gonna be another one to compensate the loss, and so to lower the volatility and the risk. And as we talked in a previous video, remember that the potential profit is always connected to the risk, and if you lower the risk, you will lower the potential profit. And so we can conclude that this instrument is highly recommended to investors that are more conservatives, to people that don't want to see their capital go up and down like a roller coaster, and also don't want to choose themselves the single assets, rather follow an index. But so how do I buy ETFs? Well, this is the fun part. ETFs actually trade like stocks, so you can simply ask to your bank, or you can even open a brokerage account so you can lower the costs. And also, unlike mutual funds, ETFs are available throughout the entire trading day. And hey, if you're thinking about buying ETFs, just keep in mind that even though they are less risky than single assets, you still need to make a research in order to choose which ones to buy. Of course, there are many types of indices, and there are certain indices that can be bought with no much research, such as the MSCI World. But if you want to be more efficient, you can choose specific sector indices. So for example, if I want to buy an ETF that follows a sector of the US stock market, it would be a great idea to see which sector is best performing, and then of course buy the relevant ETF. And I made a video to see if a sector is outperforming or underperforming the market of reference. I will put it in the description, or you can click the I button here. And so this is how ETFs work, how you can buy ETFs, and also how they actually are created. And hey, if you enjoyed the video, please leave it a like and let me know in the comments down below if you're thinking about buying or not an ETF. And I'll see you in the next video. So how do I find stocks that are beating the market? How do I know if a stock that I wanna buy is beating the market? Another good way to use this indicator is to find the best sectors to invest in, the sectors that are beating the general market. If I compare a sector such as the technological sector with a market